Okay, guys, back here with a look at the S&P. As I said I would here, just a little something to chew on over the weekend. This is a really interesting count here for an Elliottian, and it's going to be very interesting to see how this resolves. So, of course, now we've been through this a couple of times, and a part of what's making this so challenging is that this is open to interpretation, as is this, right? It's mixed blessing of Elliott Wave. So we can count this as a 3 coming down. And for bulls, that's what you want to do, right? So you want to call that an ABC so that we can call this an impulse, and we're going off to blow out the all-time highs. I'm not so sure. I flipped, right? So when I changed my count based on what happened as we went up here. So I had been thinking that this was impulsive, but having dug through it again and looking again, I think we've got to. Well, let me rephrase. There is a very strong case for this to be an ABC. All right, so the issue is all right in here because this leg here, I think there's no way to count this. You have to count this as an impulse. We have to go 3, 4, and then we have to get the diagonal in there. Let me get that. There's something you don't hear a lot in the background where I live, sirens. Okay, so I think this has to be, we have to call this a completed impulse. 1, 2, 3, yeah, the 4 is a little skinny, but it's the diagonal at the end. Because it's you look at it and you want to go, oh, okay, 1, 2, 3, oh, that certainly looks like a 4, and then you want to do that. I feel you there. I get that. I see that. But boy, if you break down into the subdivision, it's a force fit. It really is. And then this is a 5 here as well. So it's it can go either way, right? So it's challenging here. And so, of course, part of the issue here is that we have the market is not being allowed to move naturally, right? So we have all of this intervention from the central bank. Oh, I can leave the politics out of it. But so we do not have a naturally moving market. But again, right, I think I mentioned this last S&P video we did. Even though it's being distorted by the Federal Reserve, Elliott Wave is going to help you determine the probability zones based on how it moves when it's moving. It's not so much about, well, given the Elliott count here and what's going on with the Fed, we can draw the following conclusions. The Fed is manipulating the market. I think we can all agree. How about I say it this way? The Fed is certainly has a rather substantial influence on the market here. So they're doing everything they can, literally everything they possibly can do to support the market. So it's the Fed versus COVID is what's happening here. Now, I'm not so sure, right? We all know you don't want to fight the Fed. I'm not so sure they can beat this. I mean, it's really, I sit here in Texas where we've got a new daily high here in terms of new cases. I mean, it's kind of looking pretty grim. Now, you don't want to let external influences affect how you're interpreting the market. You got to go based on what you can see, because this I can be definitive about. Anything that's happening after the last pivot is just speculation. So we use the Elliott Wave to guide us through where those probability zones are, because that's all you get, as I've said it 1,000 times, right? There's no certainty, there's no guarantees, there are only probabilities. Now, so and again, we've looked at it several times. Part of the reason that I have a trouble calling this an ABC is because it requires, to call this as a 5 down to complete the C at the larger degree, it requires the very unusual expanded B wave to have us finish down here. It's a really complex count. So we've got to go swing at a time. So because this is open to interpretation and we aren't going to be able to be definitive about whether this is a 3 or a 5 until we see how all of this resolves. Well, a few things I can say with certainty. As of this moment in time, this is an internal retracement. We're still internal of this swing. So we have a pivot here. Now we've blown through the golden zone, went up towards the 786. So now as we are selling off here, well, we have the internal retracement, swing low, swing high here, right, where we'd be looking for something down here, right, well, there's your target. But we have the same thing happening here, right? So we have a swing, Never on the first click. We have a swing here, right? So we have a swing here. So right now, this is internal to this. So let's go break this down a little bit, because I think there is a trade here. Well, again, at least I can show you how I'm going to trade it in the options market. and I'm accommodating the, I don't know what I want that. I'm accommodating the lack of certainty here, because this really could go either way. So what I think, the reason I think you can put on a trade here is because we can look at this and say, and do a little deductive reasoning. All right, so if this is going to end up being labeled as an impulse, which there is it can be done. God, a guy who's a member with us has got an interesting scenario here that we've gone into a 4, and now we've gone into a 1-2, right? And now we're going up for. Yeah, so the Elliottians are going to differ on how to interpret this, and that's, you can call it half the fun. You can call it the double-edged sword of Elliott, in that there is no definitive. Well, until it's done, rarely is there a definitive answer while you're in the middle of it, right? It's like looking at an incomplete painting, right? Your mind, what happens is your mind and your biases fill in the blanks. So if you're a bear, as I am starting to lean more and more bearish based on the count, I'm seeing an ABC here, which implies, right, at the very least, we're gonna challenge these lows. Now, challenging the lows doesn't mean you come down to the tick low. We could challenge the lows here, right? So we could draw up just a big demand zone down here when looking at the volume profile. We don't have a lot to work with, but we could use some of this and come down here. We could challenge the low without getting right to the tick low, right? So challenging the lows just means we're going to drive down lower. Well, whether this is an ABC or whatever is happening here, we've still yet to break this low. So this is still in play here as a potential internal retracement. Let's see. So I look here, yeah, it looks like we've broken the golden zone here, but we've broken it on both sides, so it's kind of interesting. If it's an ABC, all right, so let's just think it through. If it's an ABC, well, here, let me go, let's try 1 hour. This is what I think is the variable that is influencing, well, certainly it's influencing my thinking. Okay, so if this is an ABC, well, what are you looking for? If it's an ABC, you're anticipating that the coming off of the C, you'd be looking for an impulse, right? So if it's an ABC, are we going to go? So one possibility, right? If it's an ABC, we've got a 1 in, some sort of a 2 has gone in here, maybe, we'll see. It was some sort of 2, and we're going 3, 4, 5, and we're going much lower. One possibility, right? If the other possibility here, just thinking through, okay, what are all the possible scenarios here? Well, if this is an ABC, right? Again, if I hang on to that, well, this could be, a W, X going in Y. So there certainly is the possibility that we're just going, there's the ABC of the W, we're going to go A, B, C, the W, X, and then we're going to go A, B, C for the Y, right? So all of that could have us ultimately going back to challenge those highs. Right? Certainly not unreasonable in terms of possible scenarios. Now, if this is going to end up being classified as a completed impulse, which I think is the least probable of all the scenarios here, because it's really of an Elliott shuffle to get this to fit as an impulse, you're going to have to compromise somewhere. What I think it does not lend itself to any compromise is this wave here. This 5 down is hard to well, how do I say that? It's hard to ignore it, right? So this is screaming at you, impulse down. Okay, so Sensei Tudum and I go back and forth on this. We're trying to resolve it, and so one possibility here is we've got a 5 down. We're doing an A. We're in the process of the B before we put in a C before we head down. Right? Certainly one scenario as well. So you're kind of left here. Well, okay, what can we be objective about? Well, we can certainly identify, even if I used this upper range here, all of this, right? It's so much like Bitcoin, right? So we've just got this big, wide range here that we've just, well, even if I do it this way. Right? So we're getting all of this volume profile here, all of this market acceptance up here at this range here, right? So it screams off the high. It's so funny, right? So when the market's screaming higher, it's, well, V-shaped recovery. As soon as we get a little soft, right, then then it's talking heads, well, too far, too fast, and maybe we got ahead of ourselves, blah, blah, blah. It's the same shit, right? They always have to rationalize it. Well, as a technician, what we want to try and do is be as definitive about what can we say, what can we see and say with certainty. I don't think you can, there's probably always a way to do it. This is 5, right? As far as I'm concerned, this is a 5. So it has to be related to something. So either it's finishing something or starting something. So if it's starting something, well, this gets a little funky to think that we put in a 2 here, right? Because could this be 1? If this is an ABC, is that 1, 2? And as I was just saying, we're going 3, 4, 5. Well, if that's 3, 4, 5 going down, then we got a world. Our whole dynamic in the equity markets is going to change, because that would just be the 1 wave. I'm not prepared to go there yet, but so here's where I'm trying to get us to. All right, because of the uncertainty. So let's try and frame it. Okay, regardless, it's a swing. How about we call it that way? Whether it's ultimately going to be called a 3 or a 5. Yeah, remains to be seen, but it's a swing. So if I've got a swing and I'm looking for an area where I might anticipate, at the very least, some algo participation. Well, look here, I got a nice little divot in the volume profile. Yeah, we pick it up again down here as the golden zone relates to all this structure here. Right, so we see that here in the volume profile. I know it's a little harder to see, but it'll be obvious on yours. Right, so we look down here and go, okay, well, if it's going to retrace, if we're going to do a retrace, well, this would be a reasonable target. Bull or bear, wouldn't matter, right? God, never the first click. Swing, internal retracement, are we doing that? I mean, we could be doing that as an ABC or a WXY. Lots of ways this can play out, right? And we have just we have a couple of wild cards. We have the Fed just willing to do anything to support the market, and you have the virus that doesn't give a shit. Who wins this, right? So how do you trade it? So of course, one very reasonable position would be, out of the market. I'm going to assume most people have some equities that they're holding. So how could we possibly put together a trade that could accommodate this uncertainty? Well, you'll recall from the trade when was it? Let's see, what did I do? It was the options count. I want to say it was about a week ago. So if you, what's the date? It was on June 16th, right? So if you want to go back and kind of revisit that, one of the advantages of selling out of the money options is that time is working for you. So this count, we put on a credit spread, a spread above, and use that to buy a put spread below, right? Just to be a brief, right? So as we are just kind of chopping around here, because we sold out of the money premium, the time decay is working for you. So one of the advantages about options is you don't have to be right about where the market is going. Let me say it this way. It's a much bigger target to say where is the market not likely to be rather than where is it going to be. If that makes sense. So if you follow me there, let's go to a 3 hour. So if my view is, okay, I've got this big range here. If we're going to come down and we're going to hit some support here, well, then I can define a range, right? So here's potentially something that has pivoted here, and then here would be the structure. So what we can do with options is we can say, okay, based on that range over, in the trade I'm going to propose to you, I looked at it over the next 40 days, right? So I want to look between essentially as we close in on the end of June to the beginning of August. So over the summer, when the market tends to be a bit soft and less volatile, of course, right? All bets are off now in the COVID time. But it's more typical that the market will be soft or sideways in the summer months. Right? Traders, Wall Street, is off to the Hamptons. So there's a tendency for lower volatility into the summer. Again, it's a tendency that may be challenged because of the COVID dynamic, right? So, but just looking at that, so I look at it and go, okay, well, so this high up here, let's call it 3,200 to a reasonable target down here. Let's use 2,700. So what you can do with options is structure a trade to say, okay, I believe that the market is going to be somewhere between 3,200 and 2,700 between now and the beginning of August. So because of the lack of directional certainty in terms of an Elliott count, I want to put together a trade that's going to accommodate this big range And let me take advantage of the inherent time decay of options. Remember, options are wasting assets, right? They are burning. Value is burned out of the price of an option every day. So, I mean, we can construct a trade and we can look at it's essentially the daily burn rate. It's the theta, right? For those of you that know options, as part of the Greeks, it's the daily burn of an option, particularly. So, just to think of it simply, right? For any of you that are new to options, an out of the money option has no intrinsic value. It only has time value and then the implied volatility. We'll get into some of that. But if it's not in the money, right, its only value is ultimately time and then the market's anticipation of volatility, which is referred to as the implied volatility, as that would affect the pricing of the option. Of course, interest rates would have some dynamic in there as well. But for the out of the money option, the benefit of selling it is, of course, that you get the benefit of time decay, which is why 90% of options that are bought expire worthless, right? So if you can get those kind of odds, you say, well, why would I ever want to be a buyer? Well, when you have directional clarity and you want to take a directionally biased move, well, then I can put together an option trade that can give me that kind of directional bias, but you can also kind of hedge it along the way in case you're right about direction, but you're wrong about the time. Right, so that it's often described as three-dimensional chess because you can use these additional variables here to construct a trade that will take advantage of a sideways market and time decay of options. Right, so all of that said, so here's the range. So what you can do with an option model. So what I'll do, and again, this comes from years of doing this, both as a trader and a broker. My view would be, okay, if the market's going to be between 3,200 and 2,700. I can go to an option model and say, okay, well, there's the time frame, there's the price range that I'm anticipating, and I'd like to look at option trades that would be profitable between now and August 1st. All right, so you run through an option model, it'll spit through, look at hundreds of trades, and then you come up with one, and based off of those results, you come up with a trade that you like. So that's exactly what I've done here. So I've gone to an option model and said, okay, between now and August 1st, if we're between 3,200 and 2,700, what's the most probable trade that is hedged that I can put on? Right? I don't want naked options on either side because that exposes you to unlimited risk. So I want a hedged trade to take advantage of that range over that period of time. So I'm going to just show it to you here in Thinkorswim. So what we end up with here is, so you note here. So we're putting on a butterfly trade, which it's not terribly complicated, but it sounds exotic if you're new to options. So you can see just from the profit curve here why it's called a butterfly, right? So we get the wings on the outside. So here's one standard deviation. Here's the price point as we sit here now as I'm recording this. Here's one standard deviation on either side of it. Right now, the key component here is the time factor. Because if I take this out to, so I'd be using September options here. If I take this out to September expiration, I'm going to have a big divot in the middle. So this is a trade where your management of the trade is very time sensitive. So if I take it out to, let's see if I can. If I go to expiration, there you go. Okay, so if I take it out to expiration, here the maximum risk on this trade would be down to, be potentially 4K. Even though there's a limit on the maximum amount that I could lose, right? As in it's not an unhedged, as in open-ended exposure. Well, we sure as hell don't want to be sitting out here at expiration, right? And so you get this range, so between 3,100 and let's call it 3,300, you have the absolute worst possible place that could end up, which is why we don't take it to expiration. So let's go back to our date range here. So we want to be focused on this it's essentially the next 35 days, right? So we want to be staying here. So if the market's going to move lower towards 2,700, well, I've got a nice P&L here between 500 and, be up here in the 600-700. If the market is going to go higher. So do you see what's happening here? So I could be very wrong about my directional bias. Right? And the market could go up here and tag that algo target. We break the all-time high. We get a new high. We're up here at this range. And take note here, if we're going up here 34, 3,600, I'm still making money. Right? Well, let me rephrase that. The trade is still making money. If I go down, if I go screaming down, and we're going, now I'm limited here on how much I can make. So just like there's a limit on the amount I can lose, I'm limited on the amount I can make. So I'm up here around 900. If I get the outer wings are kicking, I've got the potential here for a really nice looking trade. But here's the risk, right? It's time-based risk. So what we're doing is we're buying one of the three. We're doing it all through calls, right? So a butterfly, you'll do it through either calls or puts collectively. So we are selling one of the 3110 calls. We're buying two of the 3220 calls, and then we're selling one of the 3330 calls, right? You're trying to do this at a credit. Right, so you'd be looking at, now sometimes it's a little tricky to get these filled, right? So you might have to back off that price because it can be problematic. These are very commonly traded. So you might have to budge off of that credit a little bit just to get the fill that you want, but you can get fairly close to this. And then it's about trade management and discipline about the time, right? Now, if the market's way down here, right, you go ahead and take your profit, right? It depends on when it gets there and how volatile. The worst case scenario for a butterfly is that it just sits quietly, it doesn't move. Right, so we want either movement one side or the other, and if it just is going to sit quietly, well, then we're just going to go ahead and get out if we get to the August and it's just sitting in one standard deviation, which is very possible, right? Could do that. If it's just going to sit here, well, we're going to go ahead and take our, what would be $200 loser here, say, okay, well, I was in the market, right? I had a nice looking risk reward structured, but because I'm going to be disciplined, right? The options require discipline. I'm going to enforce my discipline, and I'm going to get out of the trade and take the small loser, right? I just had this conversation, or conversation with anyone who's listening, about another educator who was describing the difference between finite and infinite games. And I really liked the way he described it, so I'm going to repeat it here for any of you that didn't catch that in the Bitcoin video. So what he was talking about was the difference between finite and infinite games. So the example being a finite game being, which I think is a good example, a game of chess, right? So we sit down, we're going to play a game of chess. Sooner or later, we got a winner and we got a loser, right? So that is the nature of a game like that. It's a finite game. Got a winner, got a loser. Trading, quite different. Trading, there is no end. Right? It's an infinite game. So the only two participants that are in the game of trading, the infinite game of trading, are those that are trading and those that are not. Right? And why? If you were a trader and now you're not, then most likely that's because you blew out your account or you hit your max drawdown. You got to refund your account. So it's always about trade management and risk management, because the name of the game is to stay in the game. So thus the discipline, options, it's a double-edged sword, because you can always make an attempt to fix a trade or adjust a trade, to adjust the delta of the directional bias. Or, well, I'm going to sell a couple more options up here and I'm going to fix this trade. I've done it. I've been there. I've been through it with hundreds of clients, right? It's a danger. It's a slippery slope, right? Because you'll change the trade, the nature of the trade, and then all of a sudden the market will go back the other direction. Now you're changing it again, and you can end up with a real Frankenstein kind of trade. You're better to put the trade on, have an expectation, and have a discipline about when you're getting out. So here, right, we're take it to August, and if we don't get the movement that we're looking for, we get out. Right, so that's kind of the idea there. Now I'm kind of heading here kind of out of the blue, other than the fact that I've mentioned that this is likely the direction we're going to go, and then based on the survey we did of really all of our members, so existing, former, anyone that we could get a survey to look for input, and a very large percentage were asking for new content on option trading. So here, that's the advantage of this. You can put this on with about a $700 margin. I'm pretty sure. I think it was about I think it was just under 700 was the margin to put this on, right? And then you're looking to make here, if you get your max here, I'd be looking for if you can get a 30, 40, 50% return, you go ahead and take that and get out of the market, right? Live to trade another day. Don't let yourself get stuck in the middle. If it's going to go down again, so if we're really heading down, so if it starts to do something like this, right? If we get a 1-2 and we're going 3-4 and it's really, right, COVID is really impacting the broader market, well, right, that's just good for us. Now we're down at 25. So there's 2,500. So maybe we're going to the golden zone. That's 2584. So you come back here, we're at 2584. oh, here's 2580, 2509. Here you'd be at, here $600-700 on your initial. So that would be 100% return on the risk capital that you put in. So not a bad looking trade. So if you can get 100% on an option trade, that's ideal, particularly when you're selling options. It almost, the risk reward will often be negative, right? So, again, there's ways to alter that so you can have open-ended gain. But I'm kind of digressing a lot here. It's not easy to explain this, off on the fly, right? So there has to be a lot of understanding of how options are priced and how they move. But at least I can give you a visual reference so you understand the trade and why I'd be putting on that trade based on this, right? So it all comes back to what's happening on the chart. Where's the count? What does it look like? Can we be definitive? Do we have a strong directional bias? Last thing we'll look at here before I wrap it here. Let's go down to the 15-minute, because this was kind of interesting watching this morning, and all of my day traders have been all over this. Okay, so let's back up just a little bit. Here, let me get this. What do I got? 15. Let me go to a 30-minute. Okay, so here, this from this pivot down here, right? I'm sure, right? More members have all done this, right? If you're watching on YouTube, I hope you've already done this. All right, so if I get it right on the tick. All right, so note, right? So what do we do, right? Note, again, I emphasize this so that you don't make this mistake. The reason I add the 65 is because I saw time and time and time again the 618 was breaking. So, really, I came up with the 65 just from trial and error. And now I see the 65 breaking by a tick or two as well, right? So because this has become quite common. You'll see golden zone all over the place, right? People that don't, maybe it's for me, maybe not, right? So, but point being that I'm starting to see 1 and 2 tick breaks on the 65. So it's possible that the algos have been recalibrated to use a 66 or 60. Again, I'm guessing here. But what we do see here, we know that this is still active. So we know, right? God, again, as I've said many times, God knows how many algorithms are using this, how many are in the market. But we know it's still active, right? When we're hitting it to the tick, right? So algos are still using it, right? So there's 65 to the tick, we get the reaction. Now we're coming down, all right? So this is our currently, well, we can just kind of draw this over and look at it and say, okay, well, here's the support, right? If we break this, we're going, right? Next pivot, we're going down. So we're sitting right here now at the 50, we've done 618. Now we're here was the first time at the 50, bounce, golden zone, bounce, back to the 50, bounce, right? We're going to get a bounce here. Well, note what we just did, right? It's looking tenuous. So we're bouncing. Note there's a little low volume divot. So this is vulnerable to come down a little further. And that little low volume divot, likely, as we bring it up here, it's going to be this little bank of pivots right here. We did not have market acceptance here, which creates the little divot in the volume profile. So if we're going to come down, well, note this here. Let me go back to the 15-minute. So from this little low here, oh, look out, right? What did we just do? We just broke the golden zone. Note here, so that you see it. So swing high, we go from this 65 to the tick up. Now we hit 65, and it looked like, that was yesterday, it looked like we had the bounce. So everybody was thinking, oh, well, this impulse here, which I have labeled as an A wave, 1, 2, 3, 4, 5, hard to miss that. So we were thinking, oh, okay, well, there's a ABC or WXY, however you want to call it. But with this break now, you got to rethink that. So what I think is happening in the short term, let's get this off of here. I think we've gone WX, and we're in the process of seeking that Y. So if this is W and this is X, right? So we can get the ABC here, and we can do it. You get a flat here. So you get an A, a B, and a C coming down for the W, A, B, right? You have to accommodate that big wick, right? Then we go up for the C of the X. Now that sure looks like an impulse coming down. A, B, right into the A, B, C of the B at this degree. Now look what we're doing, right? So it looks like we could be getting the 3 here. Let's go down. Oh shit! Let's see if I can even go a little further. 1, 2, is the 3 in, or is it this? Is this it? Right? Is it 3, 4, 5 right here? We're going to be right at the 50. Is that right? All of this now done? Right. Because I'm not sure, or because nobody can really be certain as to how we're going to respond here and how the market's going to respond on Monday. The other benefit of putting on a trade like this on a Friday is I get the free time decay over the weekend. Right? So I like to put on these kind of trades on a Friday. I get free time decay over the weekend, right? Where I'm not exposed, but the option value is ticking off every day. Right, so anywhere in this range, or if I'm wildly wrong about the upside or wildly right about the downside, nice looking trade. Right, the only thing that really hurts me is if we sit right smack dab where 3,100 would be my worst case scenario. So sitting right back here at here's the point of control at 3,100. Sitting right back there when we get to the 1st of August, that's my worst case scenario. It'll be interesting to see. They're going to challenge this low again. So there's a count in here that would have this continuing to go lower. So if this is 1, 2, the 3, 4 doesn't look right. So the possibility here is that the 3 is still going in, and we've got the 4 and the 5 still yet to come. So you could have a 1, 2, 3, 4, 5, and so the 3 actually could be in here. Hard to say. Well, we'll see, right? Do we sell off at the end of the day into the close, or we're going to get the afternoon rally? It looks to me like it's weak, right? So we could be heading down here. So what that means, we can put this whole thing together. So from the high here, right? Well, this is going to be technical, right? We got a pivot right here. So we came to the 50. Let's use that. That'll be our X here. So here we come to the 50. We don't quite make golden zone. We get this 1, 2. Now, if this is 3 or this is 3 and 4 is still yet to come, we have to wait and see. This wouldn't be shocking. So here's from the swing high. Internal retracement, looking to go external, right? That's always what we're trying to do. Here's the target. Here's the golden zone, right? If we're going to, here's second target. We'd be down here breaking the 65. So if this is going to sell off into the end of the day here, you're thinking, all right, 3 is still going in because relative to this 1, 2, well, hang on, let's try it. I'm trying to wrap this up here, guys. I'm rambling. Okay, so here's 2618. So if we're going to pivot down here, you can kind of see how that could play. 4, 5 still coming. Maybe the C down here. WX seeking the Y of the ABC at this degree. So we'd be thinking A, B, C down here. All right, so even something like that. And can we get 100% there? Swing. Let's use the pivot. Look where, oh, Jesus. It's just, you gotta love this stuff, right? So that would be 100% of the Y. If the 3 is still going in here, we still got a 4 and a 5 to come. 100% is sitting right at the golden zone. Isn't that pretty? Well, let's see if we can make it even sweeter, right? So this is just all the more lining up that trade. So we're gonna do it here. It's certainly possible. Certainly possible. All right, so interesting scenario. So there's the trade. I like it. I think I will put this on. -1, +2, -1, 31.10, 32.20, 33.30. All right. We'll be doing a lot of option trades as we go through the summer and into the fall. And then certainly we'll have full course content going into the fall. Okay, guys, there you go. Plenty to chew on. Have a great weekend, and we'll catch up with you guys next